to part 2 of IAS 28 video class, investment in associates and investments in joint ventures. So if you haven't watched part 1, start by watching part 1. So for part 2, we agreed that we're now going to be focusing on intra-group transactions. But for part 2, I'll only focus on the transactions which will be going downstream. I'll explain in a minute what I mean by that. So when you talk about investments in associates, we're saying one entity is invested in the other entity, and they've got significant influence in that other entity. But the problem which comes through is most of the times when you try to get influence over another entity, it's because there's certain gains that you want to get from a point of operational. So operationally, there's certain synergies that you're expecting to benefit from. So you tend to realize that there are often some transactions which take place between the investor and the investee. So I may be using my investee, my investment in associate, to push through my products to the market. Or I may be using my investment in associate is the one which supplies me with my raw materials. I'm trying to secure a raw material line so that my operations are not affected. Now, when that starts happening, when those transactions start happening between the investor and the investee, it creates challenges when you get to group level, when you're accounting at group level, because we need to reverse all those intra-group transactions. So that is the purpose of part 2 and part 3 of this video class. So when you've got intra-group transactions which are taking place, what is mostly important is you need to identify the transactions which affect the statement of comprehensive income. You need to identify the transactions which affect the statement of financial position. Once you identify them, you need to calculate if there is any component of unrealized profits. So the intention is all the profits which are supposed to account for at group level should have been realized. If there's any component which is not yet realized, it should not be accounted for. Now let me give a simple illustration. Let's say I've got this pointer which is worth $10. Let's say in my books it has got a carrying amount of $7 at the moment. Now, so my right pocket has got a pointer which it has. And if I go to my left pocket, so better example, let's say it's worth $3. So this has got a carrying amount of $3 and it's sitting in my right pocket. My left pocket has got this bill of $5, which is sitting to my left. If I take this pointer from my right hand and I sell it to my left hand, and we transact, which means money flows, and then we now have $5. Then in my books, all of a sudden, this jumps from $3 to $5, because this is now accounting for this as $5. And we've got money here, which is sitting as $5, which means in my books, I've now recorded a profit of an extra $2 from the 3 to the 5 proceeds. Now, the question is, has anything really changed on you? Nothing. I had $5 before, I had the pointer before. So by shifting this pointer from the right hand going to the left hand, doesn't mean that I've made money for myself. So the $2 becomes unrealized profit until I actually sell this pointer to a third party who's not myself. Then at that point, then we then say, we have now realized that $2. And put back my money in my pocket. Now, so when we talk about intra-group transactions, we are considering that you've got entity P, which we assume to be the investor in this case, and you've got the associate, which you have. And if this associate sells anything to the parent company, if there was, let's say, a 30% shareholding, then by selling anything to the parent company, they're going to make a profit. But if they make a profit, let's assume to be 3,000. This profit to P, when P accounts for associate, remember they account for the associate using the equity method. And equity method says P should take a share of profits to the extent of 30%. So any profit which has been made by the associate, P will take 30% of that. But when they check the share of profit of this 3,000, has this 3,000 really been met? When P looks at this, the transaction was between P and S, which means P is going to take 30% of the 3,000. But of this 30% of the 3,000, part of the transactions was with themselves, which means it has not been realized until P says they are now going to sell this to a third party. That's when the profit becomes realized. So to the extent of 30%, this 3,000 has not been realized. It's not supposed to be accounted for as profit by P, and it only becomes profit to P when it goes to a third party. So that is what we want to try and achieve on this video class, but we'll go slowly. So let's start now with elimination of intergroup rules. So there are certain rules which are there when you've got an intragroup transaction. So rule number one is eliminate the profit which has not been realized, which we talked about. So number one, you need to know, is there any unrealized profit? And it is an unrealized profit if we have not sold to any third parties. So if we've got an asset which has been sold and is still within the group, then there is unrealized profit to that extent. But the profit which you eliminate, you do not eliminate 100% of the profit which have been made. You only eliminate to the extent of the portion of the acquirer, which, for example, if you've got 40% investment stake, then you also eliminate only to the extent of the 40%. I will also illustrate that in an example. Then rule number two is, when you are eliminating, you need to eliminate against the line item which has been affected. So when you are counting, when you're using equity accounting, obviously there is share of profits which is affected, or there is share of other income which is affected, or it is the investment itself which is affected. But also in my books, there are certain line items which may have been affected. So I also need to consider which line items do I have which have been affected in the parents' books. So those are the two rules which are there. So number one, eliminate the profit which has been unrealized to the extent of the acquirer's portion. And number two, eliminate on each line item which has been affected. Then when we look at intergroup transaction, we consider if the transaction is downstream or if the transaction is upstream. And I said for part two, we're only going to be focusing on transactions which are going downstream. So the first thing that we need to do is identify what has been sold if it's a downstream. So remember we said for a downstream, it's the parent which is selling to the associate. So what exactly has been sold? It might be inventory which has been sold. So if it's inventory which has been sold, then we consider which line items have been affected when we sold. Obviously, it's your revenue because you've sold, and your cost of sales because that sale has got a cost attached to it. So these are the two line items which will be affected from a parent's point of view, which needs to be eliminated. Then we also consider in the books of the associate, what did they take it to be? So they may have taken it to be inventory. But remember, we do not take a share of every line item in the statement of financial position. We only take share of profits, and the value of the investment, we reflect it as the investment in associate. So that means from a balance sheet level, we consider it to be investment in associate, not the actual line item in the statement of financial position. So if it's downstream, as you can see, the impact is directly to the P&L of the investor as well as investment in associate. Then we might have sold inventory, but it's taken as PPE by the associate. Again, same applies. If the impact is in the balance sheet of the associate, we do not take the line item specifically of the associate, but rather we say the impact is on our investment in associate because it is our investment book value which would have been affected. But in our books, obviously, the specific line items in the P&L will be the ones which have been affected. Sometimes we can sell PPE. Remember, when you sell PPE, then you can either have a gain or a loss on disposal. So that means in our P&L, we're looking at gain or loss on disposal. But when it gets to the associate is going to recognize that there's PPO in inventory. Since it's a balance sheet line item in the associate, we do not take share of balance sheet line items, so the impact will also be to the investment in an associate. So that will be what we account for. Now, let's try and put this in an example to illustrate. So let's say on 1 January 2017, P Limited, with 40% significant influence in A Limited, has been selling inventory to A Limited at a profit of 50% on cost. So that means 50% here is our markup. And we have got 40%. So this is the portion which belongs to us. And included in the inventories of A Limited on 31 December 2017, so there is a portion of that inventory which is still at hand or on hand is the 31 December 2017. And there is another one as well which is there on 31 December 2018. So the one for 31 December 2017 is 15,000 and the one which is there for 2018 is 30,000, which means when P Limited sold to A Limited downstream, P Limited made a profit. When they made a profit, the profit which they have in their books is only supposed to be recognized if that sale has gone outside the group to a third party. But we know that there are certain inventories which were sold here which are not yet to third parties, which are still within the group, and that's to an extent of 15,000 in 2017 and to an extent of 30,000 in 2018. But we are then told that the total sales to A Limited for the whole year amounted to 100,000. So I'll take note of those ones on the side. Please take note of these so that we discuss as we go further. So what we have right now, what we know is there is 40% stake in the associate. Then there is inventory which is being sold downstream. So I'm noting downstream here. And in 2017, I'm noting that they sold inventory worth 100,000. However, there is a balance at hand which is to the extent of 15,000. And in 2018, they also sold inventory of 100,000. However, there is a balance which is there of 30,000. And for each sale which was done, there was a markup of 50%. So what problems do we have? Number one, for us to understand the problem here, let's look at what was done by each of the entities to see where the problem is lying. So when we go to the books of the parent company, or P, we know that P is the one who sold. So when P sold, P made certain journal entries, which were obviously P received money, so P debited bank to the extent of 100,000. And that was for sales which P made. So credit 100K worth of sales. At the moment you sell, you need to get rid of the inventory. So credit inventory, but the inventory is measured at what? 50% markup. So for us to get back to the value of inventory, that means 100 over 150 multiplied by the 100 which was made. And if I take my calculator here to calculate that, if we take 100 divided by 150 times 100, that is 66.667. And that one is a debit to cost of sales. So that means 0.667K, 0.667K. So this is the amount which was made, 66,667. So wait, so this was what was done by the parent company. Now let's look at what was done by the associate company. So the associate company obviously is the one which paid. So they have got amount that they paid, bank 100,000, and they also have a debit which is to the extent of they bought inventory which also translates to 100,000. Now here's the problem. Of this 100,000, not all of it was actually sold. In 2017, there is still a balance which is there, which is of 15,000. Now, for the inventory which was sold out, we don't have any issues because the profit which was made was realized. So when you look at what profit did the parent make, the parent had sales of 100,000 and cost of 66.667, which means they actually made a profit of 33,334. Okay, this is the profit that they made. Of this profit of 33,000, are they supposed to recognize all of it? Yes, to the extent that it has been sold to a third party. But we know that there is 15,000 here which has not been sold to a third party, which means the profit which the parent recognized here is overstated by the unrealized component, which also means that the inventory which is sitting at the end of the year of 15,000 here in the books of the associate is also overstated. So the moment with the associate being overstated, that also means our investment in the associate is also overstated. So when I look at this, it means the overstated figures are my investment in associate is overstated, as well as my profit which I've made in my books are also overstated. So I need to reverse the sales which are unrealized from my books. I also need to reverse the extent of the investment in associate over subscription which has been made. Okay. So which means my journal entries in 2017 now to reverse that are, I know that there is a portion of sales which I recorded which is not supposed to be there. So to reverse that portion of sales, I'm supposed to debit sales. But how much of the sales have not yet gone out in 2017? Out of the 100,000 which I sold, how much has not been sold out? It's only to the extent of 15,000. But remember, 15,000, I don't own all of the 15,000. The rules say you eliminate the unrealized to the extent of your portion. So the sales that I'm supposed to reverse are only 15,000, but to the extent of my 40% investment. So if we do that, that means if we take 40% investment, 0.4 multiplied by 15,000, we are supposed to remove sales only to the extent of 6,000. Then we know that these sales have got a cost. So we also need to eliminate the cost of sales to the extent of 100 over 150 times 6,000, which gives us 4,000. Then we know that, so we have covered the profit which I recognize as a parent, which was not supposed to be there. But we also talked about the inventory which is sitting in the investee is also oversubscribed. It's also overstated. And if the assets in the investment in the associate are overstated, that also means my investment in that associate is overstated. So I need to reduce my investment in associate by the 2,000, which is oversubscribed to the inventory in the associate, which increased the value of the associate by an unrealized component. So this would be my journal entry in 2017, which is there to reverse the unrealized profit. So if I'm going to put a narration, then I'll be like this: being a reversal of unrealized profits in 2017. Now let's go to 2018 now. So what are the journal entries which will be required in 2018? So I'll start with, obviously we need to start with an opening balance. So those journal entries which we did in 2017 come as an opening balance. So obviously we reduced our retained earnings by 2,000, which was that 6,000 sales and 4,000 cost of sales, which gave a profit of 2,000, which went for retained earnings. So when you get to 2018, all of the amount is now sitting in the retained earnings. So this would be my debit, and my credit still would be my investment in associate to the extent of 2,000. But now, in 2017, what then happens is I then subsequently then sell this inventory. So when the sale actually takes place, I now need to recognize, because that means that that inventory is now gone outside to a third party. So the moment I make the sale, then I am now allowed to recognize that profit which was made. So in that case, that means I now record now my sales in 2018. They were unrealized, but they went to a third party in 2018. So in 2018, that's when I actually realized those sales of 6,000 and the cost of sale to the extent of 4,000. And my investment, which I said was oversubscribed, I reduced it. Now the actual value has been created. So I can now increase my investment in my associate. So this will be the journal entry. So when you look at downstream, you then realize that your downstream affects your investment in associate and the specific line items in the books of the parent. Okay. So that is your impact. Okay. Then we also have 30,000. We're told that there's 30,000 which was there sitting as stock in 2018, which means the 2018 stock was also not done. Now, pause the video, do the journal entry that you think is supposed to be done to de-recognize the unrealized profit in 2018. Now I'll give you the journal here, hoping that you've done yours. Okay. So in 2018, I'll go again. In 2018, we know that we've done some sales of 100,000. Of those 100,000, 30 are not yet realized. They're not gone to a third party because they're sitting as inventory. The ones which have gone to third parties I'm not worried about. But the ones which are sitting with the associate I'm worried about because there's an element of unrealized profit. So I need to reduce the sales to the extent of what has not gone to the third party, which means I need to debit my sales. But this time they are to an extent of 30,000. I need to credit these sales came with a cost. So what is the cost of sale related to that? And we know that the cost of sale is 100 over 150 multiplied by 30,000. And this, if you take your calculators, 100 divided by 150 times 30,000, which will give us 20,000. But we know that this is the full amount. We need to further reduce it by 40% to get our 40%. The unrealized component is only to the extent of one portion, remember. So which means the debit which we now have is 0.4 times 30,000, which will give you 12,000. And the credit which we now have is 0.4 times the 20,000, which we have here, which will give you 8,000 cost of sales. And remember, the balancing figure, the credit one becomes credit investment in associate, because your associate is overvalued through its inventory, which is there. Therefore, we have got the remaining figure 4K, which is reducing our investment in associate. When you get to 2019, you then do the reversal when the inventory then becomes sold. So that is those are the journal entries related to your investment, your intra-group when you sell some inventory. Let's also look at the last example, which is what if you're not selling inventory, but what if you're actually selling PPE to your associate? So P Limited has got an investment of 40%, which gives them significant influence. Again, this one great. So it's basically the same example, 50% markup, and they sold equipment which has got a value of 15 5,000. Okay, so for this one, if you are to analyze this one, then sorry, I forgot another one. Depreciation here is charged at 20% per annum. So when we look at this, let's first try and figure out what happened. Parent is sold to the associate. If parent sells to the associate, what is parent making? In their P&L, they've made a gain on disposal. But they've sold PPE to themselves to the extent of 30%, which means this gain, as long as the PPE is sitting with the associate, they own 30% of that associate, which means they own 30% of the PPE which is sitting there. So when you sell your PPE to the associate to the extent of 30%, you have not made any gain because you have sold to yourself to the extent of 30%, which means this gain, we should only recognize 70% of that gain. To the extent of 30%, this is unrealized profit. Then that PPE is now sitting in the books of the associate. And when it's in the books of the associate, it has been increased by this value of the gain. But to the extent of the 30%, that gain does not exist, which means your PPE is overstated. So the books of the associate are also overstated. When the books of the associate are overstated, it means your investment in associate is also overstated. So I can see you can already visualize the journal entry which we need to do. If our investment is overstated, what do we need to do? We need to reduce it by crediting it. If we've got a gain which we made, which you say that gain is got unrealized profit, what do we need to do? We need to debit the gain to remove the unrealized component of the gain on disposal. So that's how we get to these journal entries. So we have got, if you are to do the calculations, we know that the PPE which was sold for 15,000, which means the parent obviously debited bank 15K and they credited PPE, but PPE did not have a carrying amount of 15, obviously, because there was a markup which was put to get to this 15. So if the carrying amount of the PPE was 100 over 150 times 15K, which gives you 10K, which means there was a gain on disposal of 5K which was made. So given that, you can already see that this 5K is the one that we have problems with. But we cannot eliminate the full 5K because we do not own 100% of the associate. We only own 40% of the associate. So we reduce only to the extent of our shareholding, which means if we take our calculators again and we say 0.4 multiplied by the 5,000 unrealized profit, our profit which was made, we then get the extent of the unrealized portion to us, which is 2,000, which is how we got this 2,000. Now the journal entry, if the profit here, the gain, which we credited here, is overstated by 2,000, to remove the overstated value, it means we need to debit the gain. The PPE is sitting overstated in the associate, which means our investment in associate is overstated, which also means we need to credit our investment in associate by the 2K to reduce it. Now we get into during the year. During the year, what happens? The value of the associate, the value of the PPE in the associate is 15K, but it's overstated by 2K, which means the actual value which we wanted was supposed to be 13K. So can you see that depreciation which is being done is overstated because they're taking 20% of 15K instead of 20% of 13K. So this extra 2K which we have here, which is the unrealized component, that extra 2K has got an impact on depreciation subsequently. So if depreciation was being overstated, if we reduce the overstatement, it's a benefit to us, which is why we realize that subsequent to that, we reverse the impact of the depreciation. And that then, since it's a gain, it increases the value of our investment in associate. So subsequent to that, we always debit our investment in associate and credit our depreciation by the impact of the depreciation amount. And then, so this is just for 2016. For 2017, remember we start with the opening balance. The opening balance, what is the impact that we have to our P&L? Our P&L was debited here by 2K. It was credited here by 400,000, which means the impact to the retained earnings was 1.6, and all of it was affecting credit investment and associate, debit investment and associate over here. So which is why we have got an investment in associate over here. Okay. Then again, you do the same thing. Depreciation again for 2017, you do exactly the same journal entries over there. So I need you to re-practice this example when you are on your own again, so that you make sure that you have understood the fundamentals related to this section. Okay. So again, like I said, the impact will obviously be straight to your investment in associates. So every time you've got a downstream, the impact will go straight to your investment in associates.